Chapter 16 looks at depreciation, which is actually a topic in Unit 3. We're just going to change it a little bit, but let's go over what we already know. We know that the purpose of owning a non-current asset is to use it to generate revenue. So, for example, if we had a delivery van and we were going to use it for 3 years to make sales to customers, every year we use it, we're going to make some revenue. So for the first year, let's say we make sales deliveries of 25,000, and in the second year we make sales of 25,000, and in the third year we make sales of 25,000. So every year the van's being used to earn revenue, but the problem with that is we're not allocating any expenses. So what we needed to do is allocate the usage of the asset throughout its useful life, and we called that depreciation, which was the allocation of a cost of a non-current asset over its useful working life. And it basically just represents how much of the non-current asset was used up or consumed this period in order to earn revenue from it. So what we're doing, for example, is if we had $10,000 a car and it was going to last for 5 years, we would allocate the usage each year of $2,000 depreciation. So that was $2,000 in year 1, $2,000 in year 2, 3, 4, and 5. So each year we've represented the amount that was consumed or used up with an expense, and we call that expense depreciation. So looking at that as a graph, it all comes down to economic benefits. So what we're looking at is after 1 year, we've used $2,000 of economic benefits, and that must mean there's $8,000 that are unused. So that bar here, if these economic benefits are unused, represents an asset. So if economic benefits will be consumed in the future, that's going to be an asset. So the part that's already been used up here for the consumed economic benefits this period, that represents an expense. Another year goes by, we've now consumed $4,000 of economic benefits, so our expenses are $4,000, and we've got $6,000 of economic benefits unused, which will be the carrying value of our asset. And as each year goes, we just add a little bit more to the used pile, and we eventually will use all the economic benefits, and then we'll dispose of the asset because there's no more economic benefits to be used. Let's look at why we're using depreciation over a number of years rather than just doing it all in the first year. So, for example, let's take the $10,000 van. It's going to last for 5 years, and we'll assume every year it's going to generate $8,000 of revenue. So what we should do is in year 1, with the $8,000 of revenue, we should match $2,000 of depreciation, which is the expense in using the van. Alternatively, why don't we do this? Why don't we just match the $8,000 of revenue in year 1 with all of the asset in the first year? And the reason that we don't is because it's not accurate. It doesn't reflect how much we actually used the van. We're going to keep using the van for the next 4 years. Now, in the top treatment, that's going to match up because revenue is going to be matched in year 2 with expenses of $2,000. So that's matching revenues and expenses. But if we did it in the alternative way underneath, in that second year, there's nothing left to depreciate. I guess we're saying there was no expense in using the van, which is incorrect. So what we should be doing each year is matching a little bit of the asset's use with its revenue, and then that way we don't end up with an incorrect profit by using the alternative method underneath, because if you look at it, we'll see here our profit here would be much too low because we're charging too much depreciation, but then for the following years our profit would be much too high because we don't have any expenses. So just looking at the theory that tells us to do this, one is called the reporting period principle. That says at the end of the period we've got to match all our revenues with our expenses. So depreciation represents the expense part. So each year we're representing the amount that's been consumed or used up, and we're going to match that with our revenues each year. So matching revenues and expenses. The other theory that tells us to charge depreciation is relevance. Depreciation is relevant because it represents the expense of using an asset, and that basically means we're going to calculate an accurate profit. So if we didn't charge depreciation or we charged too much, our profit's going to be wrong. So looking at the example we used, we said revenue was $8,000 with the van, we depreciated $2,000, that's a net profit of $6,000. So each year we're matching the correct amount of revenues with the correct amount of expenses, and we're getting an accurate net profit from using the van. Just to go back to Unit 3, we learned what was called Straightline depreciation, and that was where we calculated it by a formula which was cost less residual divided by useful life. So in this example, we've got a cost of $35,000 a useful life of 3 years, and an estimated residual value of $5,000, that'll work out at $10,000 of depreciation every year. So going back to the van from the first overhead, we'll see in the first year we generated $25,000 of revenue, we match $10,000 of depreciation, and we're effectively calculating a profit on using the van of $15,000. In the second year, we generated $25,000 of revenue, we're matching 10, and in the third year, we're doing the same. So depreciation is all about the matching of an expense with the revenue from using that very same asset.